I'm Anna Macdonald, Investment Strategy Director for Hargreaves Lansdown, and welcome to the latest episode of the Switch Your Money On podcast. The main interview was recorded on 23rd of June and is an investment special. I'm here today in the beautiful surrounds of St James in London to talk to Jacob de Tusch-Lec about the Global Income Fund he's been running for Artemis since 2010. What sets it apart is it is genuinely a global fund which doesn't hug the benchmark, which means it's a really very actively managed fund. It's got exposure to 24 countries and 13 currencies. It's deliberately different, that's how they describe it, with very low exposure to technology and the US and little overlap with other global income funds. In fact, I think there's 5% commonality between what Artemis owns in this portfolio and what the global peer group owns. So Jacob, good afternoon. Looking back, what is it you think you've got most right?
Firstly, I'd say we also got a lot of things wrong, and that's part of investing.
Yeah.
But it's the right question then to ask what went right, because the thing about running a fund is that you often have a number of criteria. And when the fund is doing well, people talk about performance, but we also have to grow our distribution because it's an income fund. So I think what I'm most happy about is that we've sort of been able to find the right balance between the various objectives that we have. If we only focus on one, if you only want to focus on the dividend, you might take not enough risk and underperform a market that goes up. If you only focus on performance, you might take on too much risk. And if you get it wrong, you get volatility. So I think the thing that we got right, and I know it's a bit of a bland answer, is that we've got the right balance, I think, between the risk that we took, our focus on growing the dividend and have some boring stocks in the portfolio, but also having some contrarian, non-consensus positions in areas that other investors were not focused on. I think to give a broad answer, what we've done is we've sort of tapped into a bit of a new world order that we're in. You know, rather than just think that the world after COVID was the same as the world before COVID, we sort of tapped into another zeitgeist, that inflation was a bit out of control. Prices were going up. It doesn't matter if they're going up 4%, 7%, 9%. It's no longer zero, as it was for the decade before. We tapped into the fact that the world was sort of becoming multipolar or sphere-based or breaking down, that the world order was no longer as static as it had been basically since the end of the Soviet Union. And that had implications on trade flows, tariffs. We tapped into the fact that defense budgets had to go up, and therefore defense stocks became interesting. So the common theme, I think, is sort of an idea over the last 5 years that we are leaving one world order into something which we don't know what is, but it's not going to be as pleasant as what we had. And that has implications for how you invest.
So does that mean that this new world order still has opportunity in it? Is there still alpha that you can generate in it? Or do you now need to start thinking about your next not so well-known theme? Where are you going to find your next contrary bet?
It's a really good question. It's a question I'm asking myself a lot. Because the beauty about markets is that they move quickly. Something that might go on for 5 years can be priced in an afternoon. And then it might happen over the next 5 years, but it was in the price. That's what the theory of efficient markets is all about. But as we know, markets are not really efficient. If they were, they wouldn't be jumping around up and down as much as they do. But that said, you're absolutely right that, let's take defense stocks. When we bought defense stocks, they were out of favor. Many investors were not allowed to buy them. They were seen as being not ESG friendly. And it's easy to understand why, because we'd been living in a world without wars. So there was a whole different focus. Now, you look at them and say, well, actually, we need to invest in those areas in order to keep our democracies alive and our freedoms. And a lot of investors are now sort of getting access to those stocks. When we bought them, back in 2015, after the first Ukraine war, the Crimea invasion, a lot of the stocks were trading at 9 times earnings, 10 times earnings. And then very quickly, the market priced in that spending on defense was going to go, let's say, for 0.5% of GDP or 1% of where we were, to 2 to 3 to 4 to 5, like we're seeing in Poland and other countries today. And share prices immediately priced that in, multiples go up, and those stocks went from being, let's say, 10, 12 times earnings to 30, 40 times earnings, i.e. they're pricing in all the good stuff to happen, and then once it's in the price, you're not going to get an uplift going forward. That is absolutely true, and they're no longer out of consensus, and they're well understood. So we've taken down our defense exposure from, I think at the peak, maybe 18%. Now we got 5%. And you also point to something interesting, which is that the zeitgeist I mentioned earlier, that might go on for a decade. You know, we might in 10 years' time be talking about how NATO is falling apart, or maybe we've had more countries leave the EU, or maybe we can discuss where Latin America sits. Are they pro this, or are they in China's camp or in the US camp? Maybe this will continue for a decade, but it might be that the market is there. So I completely take your point that a lot of the themes that we have made money in over the last 5 years are no longer not understood or incredibly contrarian. That said, I think it's also important that, you know, when you're an investor, you tend to have a lot of confirmation bias. So you speak to people you agree with, and you're a bit of an echo chamber, and you think everybody is positioned the way you are. When I do look at other funds out there, they might have a bit more of what we have a lot of, but they only have a bit more of it. Yeah, so they might have a bit more defense, or a bit more steel or mining, or sort of the tangible old economy stuff that we're full of. They definitely have more of it now, but they don't have as much as we have. And they still have probably too much in the old stuff that they've kept on to.
Would that be something like quality names, or low capital intensive, high return?
Yes, you have all the stuff that did very well in the QE era, where cost of capital was zero. When cost of capital is zero because rates were low and we had QE and money printing, you want quality stocks with high return on capital, these long duration quality growth stocks that re-rated to very high multiples. They've done really badly over the last 5 years. And I'll be honest, I look at some of them and think they're probably becoming interesting now. And we are looking at them on a daily basis because they're wonderful companies. Who wouldn't like to hold them? Moats and all that. But they just ended trading on very high multiples. They had a little bit too much debt coming out of the QE era. Just like the Max 7 stuff now has gone from having no debt to actually a lot of debt.
Yeah.
And we know when companies lever up, they don't become as resilient when rates go up. So you're absolutely right that when you look at people's portfolios, even though they have sort of rotated a bit, and we know the old saying that liquidity chases performance. You look at what goes up, and that's where the money goes. It just takes a while. There's no doubt that investors today, they might have not sold their quality growth holdings, but they haven't added to them. So over time, the portfolio sort of rebalances into some of the new areas. But I must say, I still look at a lot of other funds out there, and I think, okay, interesting, they still have a lot of US. They still have a lot of quite expensive stuff. They're still holding on to the things that didn't work well in recent years, and still say these are great companies. And although they've derated, let's say, from 30 to 25, they're still quite expensive. So I take the point that we are no longer contrarian. We are no longer sort of completely out there. But it's a bit of a path, you know. I think people talk about what they would like to hold, then you look under the hood, they don't actually hold it completely. So I think there's still a lot of talk about investing away from the non-tangible assets, software, asset light, global platforms, moats, defensive growth, quality growth, etc. So people might have added a bit more of the opposite. And what's the opposite? You know, very capital intensive industrials, asset-backed companies like miners or steel companies, very sort of think old economy stuff. They might have added to it, but they're not yet overweight. Another area is also financials, I think, because they sort of sit between the two camps. We've been overweight banks for a number of years now. When we bought the banks, that was probably the overweight that was the most controversial. I think people.
And was there a region where you bought those banks?
We started actually buying in Europe because European banks had been regulated so harshly for a decade that you looked at them and you thought, they hadn't been doing anything for a decade.
Just holding all that capital, yeah.
Exactly. So they had gone from being undercapitalized to overcapitalized. They'd not grown their balance sheet. They'd not been lending to anyone. So how much bad debt can you get when you haven't really been doing what you're supposed to do, which is lend? Private credit had gone in and taken on all the risky stuff that the banks didn't want to lend to. So the banks had been crowded out by private credit. And suddenly you look at them and you suddenly have some very high cash returns, which for a global income fund is really what we're looking for. So you had these banks where if you added the dividend yield and the share buybacks and looked maybe 3 years out, you would get back half of the market cap. It doesn't mean the share price will go up, but it does mean
you have an underpinned
you
share
have it
price.
exactly.
Yes.
You have there's a safety cushion there.
Yeah.
And so we bought things that, for anybody who's lived through the financial crisis, and Greek banks, Italian banks, it just sounded like things you don't want to touch with a barge pole. But actually, they'd spent a decade doing exactly the opposite of a lot of the companies we talked about before that had used the QE era to lever up. These banks had used the QE era to do the opposite, de-risk themselves. So suddenly you had this asymmetric profile where banks were returning often 10-15% cash a year. They were trading below book value. They were heavily regulated, and rates were going up because inflation was going up. And as long as we could avoid a recession, actually these were just cash machines. So we've been overweight European banks now for many years. And interestingly, I think, is that now we're discussing whether Mag 7 are overspending, stretching their balance sheets, going all in on the AI story, but we don't know who's going to be the winner. So now we're not worried about the bank's balance sheet because they've not been doing that lending. That's all private credit.
And just to say, any of the individual stocks that we're talking about, these are not recommendations to buy, and it is important to stress that diversification is always your portfolio's friend, but even more so when markets are volatile and the outlook is unclear. Let's go to the US then. You've got a very low weighting in the US, comparative to benchmark. That's something that's persisted for quite a long time. Tell me about what you do own in the US. Tell me about how you think about it. And do you think AI is overpriced, as in, do you think that investors are too excited about it?
Maybe take a step back to the fundamentals. We run an income fund. US dividend yields tend to be half of European yields, and European yields tend to be half of emerging markets. So we already sort of look at the US and say, why do we want to buy things that yield 1%?
Yeah, but you do own some stocks that don't have a great yield because
Absolutely.
You're looking at that sort of barbell. Yeah.
A bit, but also a lot of the things that we own that don't have a high yield, we bought when it had a high yield, it's just done very well.
Okay.
But to buy something from scratch yielding less than 1% on 30 times earnings, you have to say, will it ever become an income stock? I can't really blame some of our names that we bought on a 2% yield, a 3% yield. They triple share price, now the year less. If they've grown the dividend per share by 10, 20, 30, 40%, the company's done what it could. It's harder for US companies, and I look at dividend per share growth as a sort of litmus test for what you just explained. Dividend yield can be low, but if the company grows the dividend every year by 10, 15%, they're doing what they can. It's not their fault share price is going up. And often if the dividend yield is high, just because the share price went down, you don't want to buy the stock either. Yeah. So, dividend yield is a bit, I often want to look at what's behind it. So we go to the US and we look at what can we buy. And there is a sort of structural underweight in the US. Then a lot of our clients see US outperform global equities and say, shouldn't you have more in the US? And then we say, yes, but the problem is what we own in the US is not necessarily doing amazingly because we're not buying the shiny, sexy AI stocks. We might be buying a telco or a utility. We can do one thing, though. We can add back the share buybacks of the company to dividend yield and get sort of a more overall idea about how much cash they're returning. Yeah. I know our unit holders don't get share buybacks as a distribution, but it pushes forward the idea that we want companies that are good about asset allocation, capital allocation, and they can give back money. So we are sort of in the US, you've got to probably be a little bit softer around the dividend, only looking at that. Nevertheless, we go to the US, and the US is a techie and growth market, right? And it's hard for us to be overweight the US, because if we have to be overweight the US, which is still, let's say, 60% of the global benchmark. And when I launched this fund 15, 16 years ago, the US was a third of the benchmark. The global benchmark today is incredibly lopsided. Only 4% of the global population lives in the US, but 60% of the benchmark is in the US. So per capita, the US is 15 times overrepresented. It's because they got these amazing companies with very big market caps. Nevertheless, the reason we're underweight the US is that the US has done so incredibly well for many years now that the valuation premium between the US and the rest of the world is stretched. So what do we have in the US? Well, we got regional banks where we think they're not particularly expensive. The US economy is strong.
There's deregulation coming down the line. There's consolidation, perhaps. Yeah.
I thought deregulation would be too boring for this chat, but let's dive into it. So in the US...
I'm sure you can make it fun.
No, let's try. In the US, it's one of the few areas, regional banks are one of the few areas where the US has too many players. So in Europe, for example, if you go into telcos, there's probably 200 telcos in Europe. In the US, there's maybe 3. The US tends to have fewer players per capita than in Europe, because we have so many countries in Europe and we don't have a sort of very well functioning EU internal market in financials, for example. Whereas in the US, you have all these regional banks, and regulation is changing now, and we've had 2 regional banks being taken over already because they need scale. They need scale to invest in tech, they need scale to invest in AI, they need scale because you can create synergies. And under the previous Biden administration, it was really hard getting these mergers through, whereas today I think one of the companies that we had that was bought, I think the deal closed in something like 100 days.
Yeah.
So 3 months later, you've slammed the 2 balance sheets together and the 2 P&Ls, and you have tremendous synergies and capital release for regulatory reasons. And furthermore, the administration in the US is helping the regional banks in other ways, allowing them to kind of be a little bit more asset light and release capital. So it's one of the few areas where we think there is sort of a really nice bottom-up story. There's also a good
quite
top-down.
good AI story in financial services. I think it's really compelling in financial services. For example, decision-making on a loan can be completely compressed in terms of the amount of time it takes and with a lot of accuracy. So
I'm sure you can do more than they want to admit. And it's much easier to do blaming a merger. Because you say, oh, we are closing branches because we made a merger, but in reality, they're also doing the AI cuts at the same time.
Yeah. You're providing yourself some cover, I suppose.
Exactly, and a bit of confusion in the whole thing, where actually, what was the reason? So it is a compelling story, and a lot of them also are not very well run. They're sort of the sleepy part of the US financial ecosystem. And what I also like about them is that they have been losers from private credit. And private credit has been growing dramatically over the last decade. And there's a bit of regulatory arbitrage here that banks can't maybe lend as cheaply or as freely as a lot of private credit firms can do. So the banks have been crowded out. But if there's a little bit more constraints in that world, the proper cost of capital, lending risks being priced in might be good for regional banks. So that's one area where we have, and we've sort of just bought 5 or 6 of them. As I said, 2 have already been bid for, and I think having a little bit of all of them makes sense because you have a higher probability of being taken out. We sort of have in Europe, we got the boring banks, the cash cows. In Japan, we got a lot of the banks that benefit from higher rates and higher inflation. The fact that they hiked rates in Japan for the first time, in 30 years means that the banks are actually making money now. And then in the US, we have this sort of more bottom-up story. And frankly, I would say financials, barring a recession. Financials are still an interesting area, I think.
And to touch on AI, how do you feel about the way that investors are feeling about AI more broadly? Do you think there's going to be a day of reckoning, or do you think it's going to be quite slow to unfold?
People say it's a bubble, but there's that old saying that a bubble is something that keeps going up every day that you don't own, right? And there's a bit of that people have been calling it a bubble. We don't hold a lot of these AI names, and we think they're very expensive, and we can see there's a lot of exuberance, and SpaceX valuations are hard to justify, but these things can go on for a while as long as there's liquidity chasing it, as long as there are buyers, right? And the market is being driven by retail. That's the big difference now between previous bubbles or bull markets, or whatever we call it, is that there is a lot of money in the system. You know how easy it is on your platform to buy a share.
Yes.
And it doesn't matter where you are. So when something goes up, momentum is a bit of a quicker factor now than it used to be. Valuation is slightly less important. And I think in some ways, very often retail investors are smarter than institutional investors when it's momentum that goes up, because they're less worried about buying into momentum. A turning point is probably professional investors are better because they have better risk management and a slightly more valuation discipline.
Yeah.
So when you ask me about exuberance, I would say, yes, it always ends in tears, but it could take a while. And also we have to accept, doesn't matter how valuation disciplined you are, that AI is something quite special. It will change so many things in society. So what we've done is, rather than try and predict whether the winner is going to be Meta or Microsoft or Google, we've sort of just said, if these companies are raising billions, if not trillions, and growing their capex commitments every single month. Not long ago, Meta said they were going to spend $500 billion. Today, that number is $700 billion over the next 12 months. So we track that, and as long as that number is going up and you add all the big companies together, that money has to be spent. Is it going to be spent wisely or not? We don't even have to make that judgment.
So if you're buying the sort of picks and shovels behind that, what you actually need to build the data center or, to do the chips, all this kind of stuff, if you're actually doing that, That again, I can see that trade works very well, but then that is also becoming quite a well-followed trade, isn't it?
Yes.
Or are you looking at it in a different way than I'm reading about people who, let's say buying Nvidia, that would be the ultimate, but you've got Samsung. Is there a way you can approach it differently from others?
What has surprised me a bit is how a lot of the picks and shovels have kept going up because they benefit from these, we call them revisions. We all know that $1 trillion is going to get spent, but if that is going to be revised up to 1.5, that still means that the picks and shovels are going to have their revenue numbers revised up. They got operational gearing, so the earnings are going up. As long as earnings are being upgraded, these stocks can work. Secondly, a lot of them are not as expensive as, let's say, the defense stocks. Samsung, I could spend an hour talking about all the risks there are for Samsung. We are, supply of memory from China. This is as good as it gets. This is ultimately a commodity. But Samsung is still on a free cash flow yield around 15%. So it's still a cheap stock. It will end in tears at some point because sometimes there's going to be a glut of memory. And also, it could roll over tomorrow if the market suddenly sees that this AI capex boom is about to end. We can see it on the horizon. The market is forward-looking and is asking, where are we in 12 months' time, 24 months' time? That's one risk to it. So we sort of have gone for the cheapest picks and shovels where we feel there's a bit of safety. And also it is a hedge because we're 20% underweight tech. So even if we have Samsung, we're still underweight. Yeah. So it's sort of a bit of just trying to solve a problem that there is no dividend yield in US tech. So where can you get exposure, whether it's a Hon Hai benefiting from putting the Nvidia racks together, or it's a Prysmian which makes fiber optic cables and high voltage cables that you basically need to get the data centers running and electrify the economy. That one is on 20 times earnings. So this is a way for us to get in there, but there's no doubt that, again, going back to retail trading ETFs, thematic ETFs, means that the correlation between an Nvidia and a Prysmian is very high because they trade in tandem. I still think that we have sort of, by going downstream, as much safety as we can hope for, but of course, if the theme is over, we're going to have to sell our picks and shovel stocks. I would just say there's a difference buying something on a, let's say, 50 times earnings and something which is on a 15 times earnings. And I go back to, again, the money raised by the Mag 7s and that whole ecosystem, SpaceX, etc. They have no choice. They have to spend that money. They've made their bet. So even if they can see that the returns on that capital might not be as high as they had hoped for. And we know that ultimately, this is not going to stop. AI investment is not going to stop. What we just don't know is who's going to be the winner. They will keep on spending, and the downstream companies are getting orders from all of them. That's one way for us where we've made good money, whether it's investing in uranium as a way of getting clean, cheap energy, cables. It's all the industrial stuff at the bottom.
And commodities too?
In theory, yes. We've heard about copper shortages now for, I think, a decade, that we need copper for electric vehicles, we need it for electrification of the economy, renewables. Copper price goes up, but we haven't had that sort of moment where it goes ballistic because there's not enough supply. But yes, I think ultimately, if one has to be consistent and say, this has to happen AI, and for that we need so much cabling, for example, and we need so much investment into electrification of the economy, and for that we need this much copper, and actually not a lot has been invested in that complex, then at some point something has to give. And we have a number of copper stocks in the portfolio. We get a yield, and I like that they're asset-backed as well. Mm-hmm. It's interesting, I mentioned before revisions to capex and how companies spent the last 10, 15 years, between QE, financial crisis, QE, and then COVID, and where we are today, to kind of change their spots. And one sector, like the mining sector, came out of the financial crisis with a lot of debt, and they sort of spent 10 years not investing in capex. They just bought back stock and grew their dividends and fixed their balance sheet. And now only is capex going on. We're seeing the same in the energy sector where no money was spent on seismic or exploration, and now as long as oil is above $60, actually they want to invest in that. So we spend a lot of time looking at balance sheets, if they're in good order, free cash flow generation, and then Does it go to pay the debt holders in form of interest? Does it go to pay shareholders in the form of share buybacks and dividends? Or is it capex? And those cycles, you can ride them. It's essentially a capital allocation cycle.
Yeah. I'm just going to ask one more question, which is more of a broader one. So whether it's within Artemis or outside Artemis, how would you think about your holding in the Global Income Fund? What would you run alongside that? How would you diversify your own exposure? Or do you feel that the Global Income Fund is actually in itself very well diversified?
No, I think you need to diversify. You don't need to over-diversify, but you need to diversify because one thing I've learned is that when things roll over, suddenly you have too much of the same. And that's just human nature. You let the winners run and suddenly all your assets are more correlated than you thought. A logical way of answering this would be, well, how are we positioned? We're always very value focused. Well, then probably we would blend well with a fund that's less valuation focused and more growth focused. We're always more or less underweight the US, underweight the dollar. Well, then we would sit nicely alongside something that's overweight the US. We're underweight tech. So if you think you can find a really good fund that knows tech and will do it much better than we would do tech, because we're not tech specialists, we're sort of classic generalists, then that would also sit well alongside it. However, frankly, I must say, most funds are very heavily overweight or heavily exposed to the US, let me say, heavily exposed to growth, heavily exposed to quality growth, heavily exposed to tech. So if anything, the issue is not so much what you should own alongside us, but that you should own us alongside them. Mm-hmm. That's how I would answer the question. But yes, I would say there is a risk that after a very good run, a number of funds look like we do. Not many, but there are more funds, which makes complete sense. And it is important not suddenly fall in the trap that you have a lot of correlated basket trades. The other thing I would also say is that when something has done really well for a while, we know that you just hit a wall a bit harder. So it's something we're doing a lot of is sort of thinking, would we buy it today if we didn't own it? You know, if you look at a stock in your portfolio that goes up every day, you think, great, we own it. But if you didn't own it, you would look at it and say, nah, I'm not going to buy it. And reconciling those two things is important. So we do a lot of top slicing because ultimately the market is in some areas. We've seen it with memory. We've seen it. I think Korea is up 200-300% year to date. That's not a healthy sign. We can come up with a lot of rational reasons for it. Yeah. But it just increases the probability that when you hit the wall, that the rollover is going to be a bit more dramatic.
It would be as disciplined as ever, even more disciplined when you've had a good run.
I think it's important to look at things and say, would I buy it today if I didn't own it? And there's a lot in our portfolio that we sort of hold and we like it, but we are well aware that it trades at a much higher multiple than we bought it at a lower dividend yield. So we have to go out and find some new ideas the whole time.
And so just as a very final thing, how does the valuation of the overall portfolio compare to what it was maybe 5 years ago?
It's not dissimilar relative to the market because the market has gotten more expensive. So for a number of years now, we've sort of been trading on a 25% discount to the market. But what is the case is that we have things in the portfolio now that on a single stock basis is a bit more expensive. Yeah. I don't like running barbell portfolios because I always thought it's a little bit, you're trying to both buy the cheap stocks and expensive stocks. But in a market that's very narrow, driven by AI, you have to sort of respect the market and get some exposure to it. And we also have a lot of names that have done really well that are no longer cheap. So we have more in the portfolio now that trades on a dividend yield less than 1.5% than we've ever had. And we have more in the portfolio that trades at a multiple higher, above 20 than we've ever had. But in aggregate, we also have the things on 7, 8, 9, 12 times earnings. So in aggregate, we still trade at a discount to the market. But there are more fat tails in the distribution.
Thank you very much, Jacob.
Thank you very much.
This session was recorded on June 23rd, 2026, and all information was correct at the time of recording. Nothing in this podcast is personal advice. You should seek advice if you're unsure what's right for you. Investments rise and fall in value, so you could get back less than you invest. The yield on investments is variable and not guaranteed, and past performance is not a guide to the future. As always, this is not a recommendation to buy, sell, or hold any of the investments or companies we have discussed today. No view is given on the present or future value or price of any investment, and investors should form their own view on any proposed investment. So all that's left for us to do is to thank our producer, Elizabeth Hotson, and thank you so much for listening. We'll be back again soon. Goodbye.